Hello and welcome to another episode of Darwin Investors. All right, good week. We're going to the moon, everybody. I've never been so happy to be a retail investor, mostly because I feel like we're the ones keeping our cool, and there's like a lot of carnage on the street. It kind of reminds me of like the running of the bulls, where we're sitting there and we're looking down the street, and all the institutions are down there, and they're getting trampled, and they're saying, buy oil, no. Mining and minerals, no. Consumer staples, no. Healthcare, no. Sell all that, buy utilities. And in the meantime, we've got our camera phones out and we're watching all the carnage going, what are you guys doing down there? It kind of reminds me of like the Enron thing going on at the dot-com boom, where you could see Enron here in what 1999 was pretty flat for most of this time, but then of course it was the dot-com bust here, and all of a sudden Enron goes, wow, let's go straight up, and then it just kept on climbing and climbing and climbing, and until it had a 63 price to earnings multiple here in 2001. And then eventually we know what happened. Everybody went broke. And so the institutions were like, let's buy Enron. At least it's not tech. And most of us retail investors are probably going, it's a utility that's going to the moon. Is that very sustainable? They're like, I don't care. It's not tech. So anyway, it still went to zero. So what are the retail investors? What are we doing? Well, we're continuing to buy the dip in tech despite recent turmoil, says TD Ameritrade. This was as of May 11th. And then the average retail investor's portfolio has lost 32% of its value in this year's sell-off. I'm only down 25, but that hasn't stopped them from buying the dip in stocks, a research firm says. And here's my favorite one here. This one's from Goldman Sachs. It says, retail investors are sticking with the US stock market so far. And it shows that retail investors who have become a key force in US equities have, for the most part, kept their cool. Yes, we have. For every $100 that's gone into stock funds during the past 74 weeks, only $2 has flowed out. That's the opposite of professional investors. He says most of whom have already exited the market. So they've exited the market, and what are they doing? Well, they've exited and now they're shorting stocks. And so they're short selling stocks, and it's the most by dollar amount since 2008. In 2008, we had Lehman Brothers going out of business, Bear Stearns, two of the bigger banks going out of business. We had bailouts of banks. We had bailouts of car companies. And you know what? I've actually tried to short sell a couple of stocks this week. I'll show you A, how to short sell, and B, how that went for me. Like what was my outcome of trying to short sell these two stocks. I'll show that later in the video. Short selling is why we had the big bounce in the market last week. And it's as much evidenced by this article here as it is by my own portfolio. I'll show you how I'm shorting the market. I just do it selling covered calls. I'll go through that when I go through my options portfolio later in this video. And what this video says is, who knows why stocks picked Tuesday to surge? But one fact to consider is the immense bout of short selling that went on last week. Hedge funds tracked by Goldman Sachs doubled down on bearish wagers, with the dollar amount of short sales hitting the highest level since the 2008 financial crisis. Similar trends were displayed at Morgan Stanley and JP Morgan, whose bearish positions increased among clients. So I get it. Things aren't looking good right now. The housing market looks like it's about to collapse. Inflation looks like it's going to the moon. But honestly, all we can do is take the data that's right in front of us, and then we will play the market using that data, not playing the market using some sort of manufactured data that we've decided to cling to confirm some sort of bearish thesis that we might have manufactured. So why were stocks squeezed this past week? Well, one, there were a lot of shorts on, and then two, a couple of companies reported earnings, and the earnings were positive. Olive Garden's parent company, Darden, beats earnings estimates as the sales jump. People are going out and going to Olive Garden, and also it looks like they also own Longhorn Steakhouse, and they own Cheddar's Scratch Grill. And people are going out to eat. Another company that reported last week was FedEx. Now their shares actually surged last week, and they brought all the other transports with them, be it UPS or Union Pacific or whatever, all comes with it, because these all trade as part of the same ETF complex. And so they kind of work together to bring each other along. But they didn't even have to beat. All they had to do was just be in line and give strong guidance, and that was enough to boost it because of all the short selling that went on. And I'll show you how I have my portfolio position. What I wanted to do was wait to the last second to sell some covered calls at the end here, but I was busy and I couldn't get to the things to a computer and do that. So I shorted around 1 o'clock, 1:30. That was the last time I was able to get to a computer on Friday. But I did want to do it right here, within 10 minutes of the closing bell, start shorting everything, because this sudden surge isn't because people were dying to hold their stocks going into the weekend. No, it's because they were closing out their short positions. That's why the S&P and all the indices spiked at the end of the day on Friday. And why are these companies reporting decent earnings, in line, decent guidance, sales and earnings beats in the case of Darden? Well, it's because people have jobs. And if they have jobs, they're going to spend money. And I know things don't look great in the economy, but if people have jobs, they're going to spend money. It isn't until they don't have jobs that they don't have money. And they're pointing to certain things that certain companies are doing layoffs. Fine, 1,000 here, 1,000 there. And I know it adds up. I get it. But on the whole, it looks like jobless claims just keep on grinding lower, and the unemployment rate just keeps getting smaller. And though it is 1,000 here, 1,000 there, I think Coinbase is laying some people off, and other companies are laying people off. If you take 200 million people that are working and you subtract, say, 100,000, that equals, I think, about 200 million. So it's like it doesn't really go down. That's why companies are still reporting decent earnings. And this is sort of the fact that a lot of analysts are neglecting to recognize. Or they can take facts and they can twist it in either way that they want to, either in their favor, in support of their thesis, or against support of their thesis. It's sort of like how there can be no good news. It's only it's only bad news because it can be interpreted two different ways. And I'll tell you what I mean by that. So something that went on last week was PMI data came out, and PMI is a manufacturing data, and manufacturing data was at 52. And so that's the lowest it's been in a very, very long time, as you can see by this chart. 50 would mean that we think that manufacturing is going to stay the same. Lower than 50 means that we feel a contraction in manufacturing. Higher than 50 means that we feel an expansion in manufacturing. And so you can look at this data two different ways. You can sit here and you can look at this data and you can say, as a bear, you can say, I told you we're going to a recession, it's going down, right? And so I knew it, and so let's go ahead and sell everything, let's short everything, right? Now, as a bull, you can say, oh, look, it went down. That means the Fed's not going to have to raise interest rates as much as we thought. It looks like inflation is going to taper down. So it all depends on what lens you're looking at this data through. And right now, the prevailing lens seems to be tipped. The scale seems to be tipped in favor of the bearish view, as this is bad. I told you we're going into a recession. So we know what happened last week. What is expected this week? Well, according to JP Morgan analyst here, he sees portfolio rebalancing lifting U.S. stocks 7% next week. Now that's pretty big, but that's what he says. He sees portfolios rebalancing lifting the stock 7% next week. And what he says is U.S. equities could see a 7% move up next week as investors rebalance their portfolios after a brutal first half of the year. JP Morgan's chief global market strategist, Marko Kolanovic, said on Friday. Now, Marko Kolanovic, he's not exactly Jamie Dimon. He works closely with them, but this guy is a bull, and he's known as a guy that is going to say things like we're going to get a 7% move up. I really like him, obviously, because I like to see the market move up. We could use people like Marko out here, and we could use people like the Prime Minister of Finland. We could use Sanna Marin. She's a prime. Visit Finland. Where was I? Let's see here. Oh yeah, stocks. So he and so since I find that my portfolio seems to it seems to mirror that of large institutions. I can actually look at my own portfolio and kind of determine what direction they're going to be going in the coming weeks. So let's have a look at where I've been going with my portfolio the last week and a half, 2 weeks or so, and where I'm going from here. So the last couple of weeks, it looks like from the 13th of June through the 25th of June, I've been up, it looks like about $358 on options. And you can see that I haven't been selling any covered calls really. This one I did sell. I sold it for 58.35 and bought it back for 59 for a net loss of $1.30. But by and large, I've been selling puts. And the reason why I haven't been selling covered calls is because covered calls is a bearish bet. And so it makes me, what that means is that I believe that the market is going to go down. So you sell covered calls to sell a short position against your long position. And so I don't believe the market is actually going to go down. So I didn't sell any covered calls. Instead, I was selling puts. And I was doing this right before earnings. And so I did it on Adobe and I did it on FedEx. And FedEx just reported last Thursday, I want to say, and so I made about 48 bucks there, and I made about 111 on Adobe. And so the reason why you want to sell puts, at least the reason why I do, is I can sell them before earnings way out of the money, and because they're so volatile, I only have to wait a day or so to cash them out for all my money. However, I don't sell them anywhere near market value that they have. I sell it way out of the money, and that helps me limit my downside. However, it also limits my upside. So instead of getting $1,000, I get $100. And so what does selling a put mean? Well, if you look at Adobe here, Adobe had an expiration of 17 June 2022. I had a strike price of $305. Adobe is currently sitting at $387. And so what this means is that if Adobe fell below 305, I would be on the hook either to close out my contract or buy 100 shares of Adobe for $305, even if Adobe was $300. But after earnings, Adobe did fall. It fell about $10 down to about $350, but it did not fall to $305. Somebody thought it would fall further, so they paid me $111, or actually $114 to hold that trade for them. I decided to take that bet. So I took the bull side and they took the bear side. There's a winner and a loser in every options trade. And so I went ahead and I won on that one. And the next week, FedEx, they went ahead and they reported earnings. And again, it went straight up and it was in line with estimates. But anymore, right now, I think in line means it's going to boost pretty good because people are going to have to close out their short positions. And so FedEx reported on the 23rd, and so I sold 2 puts on these guys because I was very bullish on these guys. One, because the unemployment rate is down, and I know people are buying things. They're not exactly buying electronics or apparel at the moment, but we are buying things. What this says is that on the 24th of June, I believe that FedEx will be over $202.50. It's currently trading in the $260 range. If it fell below $202.50, I would be on the hook to either buy out this contract or buy 100 shares at $202.50, even if the shares were $190. And someone would pay me at this time $107 to keep this trade. And I did the same thing here with a 205 strike, and somebody paid me $145 for that one, because the closer we got to earnings time, the more bullish I got on this thesis. And because I was looking up information on FedEx, nothing I'll get into in this video, but it really made me feel like I was very bullish on FedEx. Let's put it that way. I would have opened up more, but I didn't have enough margin to do it. Well, I did, but I don't want to go clear to zero, you know. So and selling puts does require margin, but you can see this is quite a change from the way that I had been trading options, in the sense that I had been trading mostly covered calls, because in this time I was more bearish. I thought that the market had more to go down, so I was selling the heck out of these covered calls, right? I don't even see a put in here anywhere. Where is my first put? This is over the last month. Over the last month, I've made about what, I guess $929 in options. And I don't see any puts in here. Oh, there's one, Five Below. I sold that put on the 2 weeks ago on the 10th. But other than that, just I've only been selling puts because right now I'm more bullish on the stock market. Before I was more bearish. So this week, the way I have myself positioned is that I've got a whole bunch of covered calls open. Now, I'm not bearish. This is actually something of a hedge right now. So I don't know what direction the market's going to go in this week. I'm currently down total $101 on all of my covered calls. I waited as long as I could on Friday to sell these because I anticipated that all these closing of short positions would happen last week. And so I wanted to get into these positions before the weekend. And I don't know what's going to happen on Monday, but I imagine it's probably going to be down because it always, well, it might boost a little bit first thing Monday morning, but by 1 or 2 o'clock, it'll probably level out and come down a little bit. But in a best case scenario, what I want is for this whole number here. I don't care where these are individually. But as long as this finishes zero, that means the market has gone up. I'm making a lot more money. I can close this out for zero, and then I can roll my bearish bet. And to show what's meant by rolling a covered call up and out, I'll just go ahead and show you one of those right now. So AMD, I go to call, and you can remember that I sold a covered call that expires on July 1st for about $96. And so when I look at that one there, it's currently valued at 21 bucks. And so I'm going to quickly show you what's meant by rolling a covered call up and out in time. So right now you can look at AMD and it has, if I do a call with a expiration date of July 1st and strike price of $96, I sell it to open. We can see that right now it sells for 21 cents a share. Each contract 100 shares, so it'd be $21. Now you can also know that July 1st is a Friday. Contracts, with the exception, very, very few exceptions, always close out on Fridays, right? And so that was another reason why you saw a sudden spike at the end of the day on Friday as people tried to cover their short positions. So this would be a short position, a covered call. I'm saying if it finishes below $96 on July 1st, someone will give me $21 to hold this contract. If it's $95, I get to keep their money and my shares. If it's over $96, provided I don't buy my way out of this contract, I got to sell them my shares for $96 each, even if it's $105. But time is worth money also. So that's what I mean by rolling it out in time. And because time is worth money, let's say I roll it out to August 19th and I roll it up to a price, even though it costs more than $95, but now it's $105 instead of $96, I've rolled it up in price and out in time. And now somebody's going to give me $184 for the same contract. And that's what I mean by I wouldn't mind actually closing out all of my positions at zero and then reselling covered calls, because believe me, I'm on the long side. The covered call positions I have right now are kind of a hedge because I'm just not exactly sure which way this market is actually teetering. Feels like it's going to go down a little bit, but I'm not sure if it's going to go up or down. So I sold some far out of the money covered calls. And then to illustrate what a put is, let's say I think this week I was going to do stars, STZ. And the reason why I like to do these before earnings is because this is when you're going to get all of your volatility. You get a lot of money for volatility when trading options. And you can see that this one's even though it's $245, $240 would be an out of the money put, meaning that 250 would be in the money, meaning that right now $245 is less than $250. So I would be paying intrinsic value for this. So $450 of this is intrinsic value to this stock price. And the rest would be extrinsic value, meaning time to maturity and volatility. And you can see that it's got about $300 worth of that. So we would sell this in the money. There's for 300, or out of the money, excuse me, that'd be 322. I would look for something that's going to only give me about $100 a premium, because I'd rather be more safe than sorry. And it looks like maybe 220, 230. Okay, so 230 would get me $115 here, and that would be if I sell to open a put. And what that says is if Constellation Brands is below $230 on the 1st of July, then I would be on the hook to buy 100 shares of Constellation Brands, or buy the contract out at an elevated price somewhere north of $115. However, if it finishes above $230, then I just get to keep the $115. And that's what I've been doing, because I've been pretty bullish. I've been thinking things are going up. However, Constellation Brands is a money-losing company. It could easily go below 230. I'm not sure I would do this for that. For Constellation, maybe I'd try to get like $50. And I said, but again, it's not looking very tantalizing. I can easily see Constellation going down $25 on that day. But in any case, it reports on Thursday. So Thursday before the market opens, actually. So I would wait on Wednesday to check out what this price is, because it might already crash going into earnings. Let's say that it crashes down to already $225. Then I can sell my put at like $200. You're not in any hurry. It just has to be before earnings, because that's when you're going to get most of your premium, because that's when it's going to be the most volatile. And so do it right before they report, and then sell it well out of the money. And $50 is nothing to sneeze at. If somebody wants to give you $50, I think we'd all take it. And so that's what my strategy is for selling puts, and then also rolling covered calls. And that's what the market's actually doing. A lot of the big hedge funds remember from that article that they were rolling their short positions. And that's what this means. They're closing them out, and then they're reselling them further up in money and out in time, or whatever they have to do to get their original money back, plus try and make a little bit on the other end. And what do I expect to have happen between now and next Friday? Well, this Wednesday, Fed Chair Powell is going to be speaking at 9 a.m. over a central bank in Portugal. And he's going to be giving the economic policy panel discussion. And that's going to happen at 9 o'clock in the morning on Wednesday. And so this little discussion here is going to spook the market. I think that the stock market this Tuesday is actually going to go down, hopefully, for me, down a little bit, enough so that I can at least make $100 or so on my short positions and cover those. And that would be going into Friday, where we're going to get another new release of PMI data. And on this Friday, again, it's all what lens you're looking through, whether you think it's good news or bad news. But I would expect the PMI data to be similar to the last print, and it's going to be pretty close to 50. And depending on how you're looking at it, it's either that we're going into a recession, or the economy is slowing down and we're not going to have to raise interest rates enough. I don't know what direction they're going to go in, but it does seem like the market is a bit bearish. I would probably put my money on the downside. But again, I'm not going to hold my covered calls until that day to find out if I can get out of my positions with, say, 50% gain. And I'm talking about 50% as a whole. Also going on next week, there's a couple of companies reporting earnings. One of them here is Nike. They're going to report on Monday. They're reporting after the bell. And another companies that are reporting that are of interest to me are Constellation Brands, STZZ, and Micron is also reporting on Thursday. I'm not crazy about any of these. I think if I had to pick one, I guess Constellation, because Olive Garden just did pretty well. However, Constellation doesn't excite me, and the reason why it doesn't excite me is because right now it seems to be anyway a money-losing company. For those of you that don't know what Constellation Brands is, they sell Negro Modelo, Corona, and all that stuff to different restaurants. They're also, I believe, in the cannabis space nowadays, and they do spirits as well. They're going to be announcing their earnings Thursday before the market opens, so probably sometime on Wednesday. I'm going to just take a quick peek at Constellation and see if I can't get $100 selling this thing well out of the money, say like at 195 strike. I don't have a lot of confidence in this one. And the reason why I don't have a lot of confidence in this one is their price to earnings ratio is nothing. And so that means that this is actually a money losing company. However, their forward PE looks to be pretty nice at 21.96, indicating that they might provide a strong guide. So I may or may not sell a put on Constellation, but it's definitely one that I'm looking at. Now, another company that's reporting on Thursday that I might dip my toes in here is Micron. Micron is they're a kind of a semiconductor company. I don't know if you've ever gone to buy a computer and you see that they'll say some are SSD versus some have different chips like Intel or AMD or what have you, processors on the inside. Micron is the SSD folks, but they're also more of a computer storage company, like NAND flash memory and that sort of thing. But nevertheless, based on Micron's earnings, the entire semiconductor complex is going to trade up or down depending on their sales, earnings, and guidance. And they'll do that because they're part of a lot of ETFs that hold the other semiconductor companies. They tend to kind of trade as a monolith. And one thing I like about this company is that they have a price to earnings ratio of 7, a forward PE of 6. One thing I don't like about this company is the fact that they're very dependent on computer sales. And we already saw that Best Buy and Walmart and Target all reflected poor sales of electronics equipment. And so I wouldn't expect Micron's going to have the best quarter in the world. And even if they have one that meets it, that's in line, I don't think their guidance is going to be particularly strong, at least not at this time. And so if I was going to trade in Micron, I definitely would be trading it, selling a put far out of the money. And I might just actually hold off on closing out my NVIDIA and AMD covered calls until after these guys report, because I suspect they're going to take the whole complex down with them. And here's the Vanex Semiconductor ETF. You can see what their holdings are here. They got, it's the semiconductor ETF, and you've got Taiwan Semi, NVIDIA, Intel, Qualcomm. And I imagine somewhere in here, you're going to find Micron as well. And Micron is right here on page 2. So these are the reasons why people will sell this ETF off, and it's just going to take everything with them. And that's what I mean by bad earnings in Micron could bring down the entire sector. Now, as promised, I'm going to show you how I tried to short sell this past week. And the company I tried to short sell was Revlon. Because they've recently declared that they're going to go bankrupt, and they seem like a real good stock to short. Their short percentage right now, their short float is 53%. So I went and I checked to make sure that it wasn't like over 100%, that I wasn't going to do something too foolish. And it looks like this is a large short percent float, but it does seem that shares are out there. The short ratio is 0.23. Short ratio means time to cover. It means you have about a fourth of a day to cover on average. That people are covering this short within the day. And so what is short selling? So I went ahead and I go here into Revlon and I said, I'm going to sell short 100 shares. Now, at the time, I thought that Revlon would squeeze up at the end of the day, and then I wanted to buy my short position at the end of the day for basically $9 a share or $900. And the way that short selling works is like this. When you go to a bank and you borrow $1,000, and then at some point after that, you have to pay them back the $1,000 with interest. Well, the way short selling works is, in this case for Revlon, I'm borrowing $900 and I'm hoping to give them back about $50 with interest, right? And the way that happens is I borrow it for $9 a share and Revlon goes down to 50 cents a share, then I win. And that is short selling. And I attempted to do that, but what happened is that you get this order right here that says, this order cannot be accepted as the security is not available to short at this time, meaning the bank will not lend you these shares and let you give them back to them for 50 cents a piece. And I did have some sort of a moral type of dilemma going on my head before I decided to short, not because I was shorting and I was going to try and screw people, but because I was going to be basically I'm not helping the system here, am I, by taking taking advantage of some poor bank who's already panicking on the streets of Pamplona, and I'm going to add some more fuel on their panic by having them lend me $900 and give them back $50 with interest. And so, but I got over it. And so when that didn't work out, I went to try and short sell Redbox. So they didn't have the Revlon shares available. So I said, well, maybe I can short sell Redbox, right? And now this is after hours. And so I'll show you what the message was that I got, because I did this yesterday. So I try to do short sell them for $1,000, like borrow 1,000, hopefully send give them back about, I don't know, $50. Well, actually, the company that's going to buy them out was going to buy them out for 69 cents. And so again, there's that number. That's so stupid. You know, like traders are so juvenile, it seems. But yeah, 69 cents is what they offered to pay for this. And so hopefully I would give them back Redbox for less than $1. So times 100, so $100, or less than 100. So I'm going to borrow 1,000, get back 100 with interest. The problem was that the interest on this was idiotic. So if you look at Redbox, it says you are placing an order on a security identified as hard to borrow. Please review the following information. Look at this interest rate I was going to have to pay for borrowing 100 shares of Redbox. I was going to have to pay 707.5% interest for a daily fee of $19.36. So I was like, well, how much freaking Redbox is being shorted right now? I mean, like, at least I could get that one, so I would assume it was going to be less than 53% because I couldn't even get the Revlon ones. And so this one is 38%, but look at this short ratio. You have the average one that's out 0.19 of a day, which makes sense because if they're going to charge you 707% interest, you're getting in and getting out as fast as humanly possible. So long story short, I never did get my short positions in one, because I didn't want to pay the interest, and two, because on Revlon, there were simply no shares available to short. But that's how you short sell, folks, if you're interested. All right, so also this week, what's going to happen is that Alphabet or Google is actually going to do their 20-for-1 stock split on Friday. The split won't actually take place until July 15th. However, the split will happen for shareholders on record as of July 1st, 2022, we'll receive 19 additional shares of Alphabet stock for every one share they own after the market closes on July 15th. If you look at what Amazon did, they had their split was on June 6th. So if you look at their stock price of Amazon, so rolling into the June 6th date, you can see that Amazon was trading at about $104 pre-split adjusted basis on May 24th, and right up to June 6th, it ran up about, what was that, 20%, or $20 a share. And so we could expect that Google might do something similar running into their split date. And I'm not guaranteeing anything, but what I am saying is I do expect Google to actually go up this week as we go into our split date of July 1st, but certainly by the split date of July 15th. So this would be one stock to keep an eye on this week. Also in news this week, Polestar became the latest electric vehicle maker to go public via the SPAC merger. Polestar is now trading from GGPI. It is now PSNY. Now, a couple of things I'm going to look for in this stock is I'm going to make sure that they hold true on the things that they say they're going to do. So long as they continue to do what they say they're going to do, I'm going to hold on to this stock. Now, rest assured, if something ridiculous happens to this stock and it goes from like $13 a share up to $30 a share, I will be selling the stock and buying it back lower. I'm not a dummy. I'm not going to hold it forever. However, what I expect is going to be kind of like a slow little grind, either sideways, a little bit down, or a little bit up from here. But as they hit their marks, it might go up a little bit more. They're comparing this merger to the likes of Lucid, Fisker, and Nikola and Rivian, but nothing could be further from the truth. I'll show you why in just a second. One thing that this this CEO says is that Ingenlath said Polestar may need to raise more cash before it turns profitable, a milestone he expects to reach before 2025. So he expects to be profitable by then. If so, he said the company will likely issue bonds rather than selling more stock. And he said likely issue bonds rather than sell more stock. If we find that Polestar is diluting their shareholders like crazy, I will be selling the stock. If they do not release the Polestar 3 like they're supposed to in October of 2022, I'll be selling the stock. Now, they're owned by Volvo, who is in turn owned by Geely. Geely is a Chinese company, and China buys an awful lot of EVs. Now, what sets Polestar apart from Lucid, Fisker, and Nikola and Rivian is when I go here to shop for at a Rivian here, you can get the Rivian for $138,000, 140. You know, you don't see a lot of them, but you can get them, and if you do want to pay for them, they're in 139, 140. Oh, here's some for 126, and then here's some for 124. Over here we've got the Lucid. The Lucid is $160,000, right? 160, 162. So that seems to be about the going price for a Lucid. However, the Polestar is selling for about $55,000. And there's a lot of them for sale. And you can buy it all over the place. They're hoping to be able to manufacture 295,000 a year by 2025. I'm also going to be looking for this. The Polestar 3 electric SUV is due to set sail in October. Here's an article that details its price, its specs, and its release date. You can see that it's a beautiful car. I didn't know what it was going to sell for. It's projected to have 372 miles of range. It's supposed to be a competitor to the Mercedes EQC and the Audi e-tron. It's going to be coming in at a price point considerably cheaper than the other two if they manage to pull it off. It's looking like it's going to be in the 50,000 pound range. So that would be about $60,000-ish. So a little bit cheaper than the Audi e-tron. And then the difference between, say, a Polestar and the other companies that we're talking about is that price range. Well, that's going to be it for the show for this week. If you got anything out of this show, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.